the three most important words in investing is the margin of safety. This is a very famous quote by Warren Buffett. But what exactly is the margin of safety? And how do you know how much of a margin of safety do you need to use when analyzing a company? I will give you a simple example, Curate Retail. I look at this company last year. It was undervalued, but I did not invest in the company. And if you look at the stock price, I was right not to invest in it. It was because of the margin of safety. The stock crashed by over 50%. So was the margin of safety 50%? If I analyze the company again, it is still undervalued. And if I apply a 50% margin of safety, it will look like a good stock to buy, but still I'm not buying it. It's because of the margin of safety. So the margin of safety is not necessarily a number. It can be a good enough reason for you not to invest in a stock. Today we are going to talk about the margin of safety, what exactly it is, my opinion on this, the opinion of other value investors. Before we talk about that, please make sure to smash the like button for the YouTube algorithm. If you are new to the channel, my name is Ishfaq. I am an elite popular investor on eToro. Please make sure to subscribe and to hit the notification bell so that you don't miss the coming videos. There are different ways you can calculate the intrinsic value of a company, but the one that I use the most is to discount future cash flows. We are not going to go into details today, but basically what it means is that if you are investing in a company, you want to know how much money in the future the company can return to you. So that would be the intrinsic value of the company. And according to value investors, the market is inefficient. What we see, the price we see, is not the value. So any company, it has an intrinsic value, and then the market will give a price to it. So to calculate the intrinsic value of a company, we discount future cash flows. So we calculate how much cash flows or owner's earnings the company can generate, and then we discount this because money today has more value than money in the future. So we use a proper discount rate and we find the intrinsic value of the company. So let's say we have calculated the intrinsic value of a company to be 100 million US dollars. And the market capitalization today, the price that the market puts on the stock, on the company, is 120 million US dollars. Does this mean that you need to buy the company? Of course not, because it is overvalued. You should not be buying the company. The market says you have to pay 120 million dollars for this company, but the real value is 100 million dollars. So why are you buying the company? Now let's say the stock price is moving. The next is 115 million dollars. After 2 weeks, it's 125 million dollars. It's always volatile, but the intrinsic value is never changing until ultimately one day it is 95 million US dollars. So now should you buy the company? Maybe you will think that it is undervalued. Now you can buy it, but you should not be buying. According to Warren Buffett, other great investors, value investors, you should take a margin of safety. So probably you're going to buy the company only when it has a market capitalization of 80 million US dollars. So what exactly is this margin of safety? Why do we take this? Maybe one of the reasons you were wrong on the calculations of the intrinsic value. So if let's say that $100 million that we calculated for the intrinsic value, if you were wrong about that, then you should not be buying at 95 because there is no single way, there is no formula for calculating the intrinsic value. It's just a company. The way you analyze it, you look at the numbers, you look at the balance sheet, you look at the assets of the company, the debt of the company, you look at the way that they can generate revenues, income, cash flows, and then you calculate the intrinsic value. But another person can look at the same numbers but interpret them in another way. So they will find another number for the intrinsic value. Maybe you want to discount the future cash flows at 10%, someone else wants to discount them at 12%. So different value investors will give different intrinsic values to the company. So which one is the right one? You cannot say that you are the one that knows everything and your calculations are the best. Maybe you have done a mistake, you have missed something somewhere. So that's why you take a margin of safety. And you will not be buying the company at 95 million US dollars. Because maybe it's 90 million dollars, maybe it's 17 million US dollars. You made such a huge mistake. That's why you take a margin of safety to avoid these mistakes. That's the number one reason why you need a margin of safety. So depending on how much you know the company, if it is a company you know very well, you have understood the sector, everything very well, you have looked at this company for years, the margin of safety doesn't have to be so big. But if it is a company which is completely new to you, the sector, the country is new to you, then maybe you are going to make more mistakes. The probability of you making mistakes is higher. You take a bigger margin of safety. Another reason why you need to take a margin of safety, it's because of countries. If you're investing in a country which is not a democratic country, which is not a country where capitalism is the rule, for example, China, you should take a bigger margin of safety. Even how much you understand the company, there is a risk that maybe the government will do something there which is not good for that particular investment. So you take a bigger margin of safety when investing in these countries. And it's not just about countries, it's also about sectors. Let's say you're investing in a miner, a copper miner, but we know copper prices are cyclical. So you take a margin of safety because you don't know how much copper prices will be in a month, in a year. It depends on economics. So you take a bigger margin of safety when investing in such companies. Speaking of economics, in general, macroeconomics, this is another thing you cannot predict. You don't know when we'll see a recession. Maybe you will tell me you will look at the yield curve, you can predict recessions, but economists most of the times are wrong. What makes you think you're going to be right? It's all about probabilities. There is a higher probability there's going to be recession, stagflation, inflation. It's all about probabilities. You cannot know for 100%. So if you think that the market, the economy is overheating and that there is a high probability that we may be in a recession because maybe the market is overheating, there is inflation, the Federal Reserve System is raising interest rates, maybe there could be a recession in the coming years. If there is a recession, the stock market may crash. Then you take a bigger margin of safety because you don't know about this. Of course, if we are in the middle of the recession and you expect that probably things are going to get better, there is going to be a recovery, then the margin of safety should be a little smaller based on this. So how much should be the margin of safety? 10%, 20%, 30%? It depends on you. It depends on you how much you want to put. I don't have a formula to calculate the margin of safety. Someone asked me why for this one it is 20%, for another company, which might look safer to you, but it's 30%. Maybe for some reason I understand the complicated company better, even though it may not look safe. That's safe for the general public. That's why I use a bigger margin of safety. So it's all dependent on you as the investor, how much you want the margin of safety to be. I'm never going to use less than 20%. It's always going to be at least 20%. Even when you're estimating future cash flows, you need to take margins of safeties there. Little margin of safeties. You don't say that because a company has been growing by 10% revenues a year that this will continue. Maybe you estimate at 8% for the next 5 years, for example. So you take margins of safeties there, you be conservative. But when you have calculated the intrinsic value, then there is an additional margin of safety you take. So if you have been very conservative in your calculation there, maybe here you can be a little less conservative. So once again, it all depends on you, on the way you understand the business. But it is important. I'm never going to take less than 20%. And at some point, I even took 50% for some companies where there is a very big risk. Now let's come back to that example, Qurate Retail. The company had a market cap over $3 billion last year. When I calculated the intrinsic value, I don't remember the exact numbers, how much it was, but it was undervalued. What matters is that I did not invest in the company because of the margin of safety. So how much was the margin of safety? It was not any number at all. The margin of safety was just a yes or no question. That's it. I did not invest in Qurate Retail because I did not like the way that their debt was structured. They had so much debt that were going to mature very recently, and the debt was still here. So that's why I did not invest in Qurate Retail. Now that the stock is down 50%, I recalculated the intrinsic value of Qurate Retail, and I saw that last year I made some mistakes. So I'm being more conservative with Qurate Retail. I found a lower intrinsic value for Qurate Retail, but the company is still undervalued. I'm still not going to invest in it. And once again, it is because of the margin of safety. Even though today it may look cheaper, I'm not going to invest in it because of this margin of safety, which is binary. It's yes or no. It's not whether you put a number, and it's all about the debt, as I told you. Let's say today the company has a market cap of $1.4 billion, 1.47 I think. So let's say $1.5 billion. Looking at the balance sheet of the company, the debt is not enough for me to invest. But let's say everything crashes and the stock falls, the market capitalization falls to, let's say, 200 million US dollars. Then maybe I can invest in it. Even though the debt is still here, why I may invest in it is because of the risk and reward. When I look at the potential reward investing at such a risk of 200 million US dollars, the risk reward asymmetry would be bigger. The amount of risk, because when the stock price of a company falls, the amount of risk you're putting on the stock is lower, but the reward, the potential reward is bigger. Today at 1.5 billion US dollars investing in Qurate Retail, I don't see that potential reward, even though my calculation says, looking at exit multiples, it says it can be a 5-bagger. I don't believe all of that because of this debt. Because if the company goes bankrupt, you lose everything. The company goes bankrupt, it doesn't matter if it is a potential 5-bagger, it can still go to zero. So you lose everything. But if let's say the stock price falls at 200 million US dollars, just an example, I'm not saying that this is the buy price. It falls at 200 million US dollars, it can still go bankrupt, but the potential reward then is much bigger. It can be a 10-20 bagger. So this is what you do when you're investing in a company. It's not just looking at the margin of safety as a number you put there. It's 50%, 80%. It can be yes or no. It can be binary. You invest in it because of such conditions. If those conditions are not met, it is not a good investment. Even how cheap it looks, even how good the numbers are. And for Qurate Retail, it was the debt, the way they were structured. For another company, it can be another one. But you still have to look at the company, update your analysis, update the margin of safety that you have used. Maybe Qurate Retail will be able to restructure their debt, make it better, and then it will meet my conditions and I will invest in it. So the margin of safety is here. The main reason why we take on margin of safety is because for the worst case scenario, which many investors ignore. They just look at the best case, this can be a 10-bagger, but most of the time the stock that can be 10 baggers can also go to zero. And I did not talk about this too much, but the margin of safety is also important related to the rest of your portfolio. Today we talk mostly about other specific companies, but it's related also to the rest of the portfolio. Because if let's say you have 2 banks in your portfolio and you find a third one, are you going to invest in another bank? No, maybe you don't want to invest in it because it is, once again, not a number. It's because you already have 2 banks, you don't want to have a third one in your portfolio. The only reason why you would want to own the third one is if it's very, very, very cheap and the potential reward is much bigger than the other 2, then maybe you should take profits with the other 2. So this is another way you can look at the margin of safety. So let me know in the comments, how do you understand the margin of safety? There is a book, The Margin of Safety by Seth Klarman. I did not read the book. It's $5,000, the book. I did not read it. Maybe if you read the book, you can tell me what do you understand by the margin of safety. Today's my interpretation of it, from reading from Warren Buffett, from Charlie Munger, from all these great value investors. This is my interpretation of the margin of safety. So let me know, what is your interpretation of the margin of safety? Thank you for watching this video. Please like, subscribe and share. Please watch these 2 videos here if you missed them. Have a nice day and goodbye.